In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast, where experts dip below the surface of important industry issues in search of hidden opportunities.
Hello, everyone. Welcome again to BlackFin Group and the Shark Cage. Very excited to hear. I've got Kenny Daniels in the room, and he's a good friend of mine, and he's been an industry leader for a long time, mortgage servicing, lending. And to be quite honest with you, I haven't caught up in it a while, so I'm really excited to have him here, and I hope you are too. Kenny, how you doing, man?
I'm doing good, Mike. Great to see you, man. You look great.
Absolutely. You as well. It's good to see your face. We haven't probably seen each other in probably like 2 years, and have a real sit down and probably maybe longer than that.
Yeah, it's been a while.
Tell me what you're doing. Tell me what you got going on.
Yeah, I'm with Quinteros, Prater, Wood and Boyer, which is a national insurance litigation firm by nature. 5,000 employees, 30 states across the country, and been here going on 6 years now. And my business partner, Mike Barker, and myself run what is the financial services division in the firm, which is mortgage and banking and commercial and kind of everything in between. So the firm itself is one of the largest insurance defense litigation firms in the country. And Mike and I, again, run a division inside of that, focusing on the mortgage industry. So it's been fun, and it's a good group of people, and it's a great company. And yeah, I'm excited to be here.
That's awesome. And so, I personally really excited what having to talk about. I don't know what it is, but let's bring it on.
Yeah, man. Yeah, I was just when we first talked last week, I just got back from DC and the five-star government forum.
That's right.
Talking about the economy and the housing industry, and seeing a bunch of old-time friends have been in the industry. This is actually, can't believe it, man. This will be my 46th year in the industry. I started back when there were three ways of communication. It was either face-to-face, phone, or U.S. mail, and that was about it, So now everybody's talking about AI, and so a lot of the discussion was around AI, and then the rest of it was really around the economy and the housing market and where it's going. And I think the takeaway from all that, just to use a word that kind of got tossed out there a lot about the housing market, is it's just stuck. It's stuck, and it has been, for several years now for myriad of reasons. So, yeah.
So I know that what we've talked about here in BlackFin are a couple of things, and I want to touch base and kind of go in a couple different verticals. One is, we've talked a lot about in different podcasts relating to consumerism and the lack thereof in the mortgage and housing industry, lack of originations, that sort of thing. And one of the big culprits, or a couple of the big culprits we talk about, is obviously cost of money, is interest rates and the perception of interest rates. The other is, there is still a lot of high credit card debt out there, very low household savings rates. And obviously we've got a housing industry. We have a lack of supply out there. For it's getting better, but what are your thoughts? And did you hear any of that resonate in the conference you were just at?
Yeah, man, it's almost like for the first time in my career, it's almost like you have a more divided housing market than I've ever seen. I mean, you've either got and a lot of the new, like here in Georgia, for the most part, the housing market is still pretty hot, but it's all based on new construction because it's a lot of raw land here. People are building new construction. People are moving here from other states. So you've got all that going on. And then you've got, other markets that are more traditional, built out markets where, the housing market is just kind of stuck. There's not a whole lot of new construction and stuff like that. But it's almost like now, you've got really, really expensive housing that very few can afford, especially in the younger generation. Either, somebody's got family money to put money down, or somebody's got a really high paid job out of college and can afford to buy something like that. Otherwise, it seems like everybody gets pushed to the rental market, and there's really no
Yeah.
in between. Yeah.
Yep. So let's go upstream a little bit. Something that's near and dear to our hearts from back in the day is default servicing and mortgage servicing in general. One of the things that we've been preaching at BlackFin Group, because we do process improvement, tech implementation, that and quality control, all those fun things, is really trying to talk operators into taking advantage of times now to really get your ducks in a row, help build the foundation of the house in preparation for potential more volume coming in servicing and potentially in default. What are your thoughts?
Yeah, yeah, man. I mean, I'm a perfect example of that. I mean, a lot of my friends have retired, moved out of the industry, people that have been in the industry for, 30, 40 years and been executives and kind of worked their way up from just like I did from a clerical job at a bank many years ago to servicing positions and now working in the law for a space and did a stop at Fannie Mae for 11, 10 years, in risk management and servicing management. But yeah, it's a whole different animal now, Mike, because a lot of the experience is gone. There's new people in the business. You've got a really challenging market where it seems like everybody that's buying a house these days is buying something that's in an inflated value, which is going to have to be dealt with at some point in time in the future.
Right.
And yeah, of course, going back to COVID, which I swear I'd quit saying that word. But it just going back to COVID, it seemed like people were, doing everything and anything they could to keep people in homes, which is greatly appreciated. But you can't do a loan modification with somebody, 6 times when none of them have actually performed and continue to expect something to work out down the road. I think it, gets down to some of the basics that me and you learned back in the day, which is to determine if somebody can afford to stay in a house and if they can't. And if they
Exactly.
can, then there's many different ways to try to solve that, but they've got to have the financial means to do it and everything else. And if they can't, then, you got to do, what you and I always did in the industry, which is you got to embrace that borrower early and try to find a good exit strategy that's amicable and that you can work something out with the guys and that kind of stuff. But at least what we're seeing now is there's kind of a push towards we're going to try to do a workout option, and if it doesn't work out, we're going to have to move to an exit strategy, which it's the first time we've seen that in years.
Yeah, it's funny you should say that. I'm glad you brought it up because we talk a lot about the fluctuation in delinquency rates and default rates. Now, given they're still really low compared to historical levels, but do you attribute that? I mean, particularly in FHA loans, they're a little bit higher in the last 6 to 8 months. But do you contribute the manageability of continued delinquency and defaults because there are still a lot of workout programs going on and different types of modifications, try to keep people in the loan and maybe not justifiably?
Oh yeah, absolutely. I mean, I think there's a lot of shadow inventory out there, word we've used time and time again in the past that at some point in time, it's going to come to fruition and, it's going to have to be dealt with. And, a lot of that stuff is stuff that was in a workout scenario over the last, 4 years. And now people are kind of addressing things a little bit differently. I mean, you got to look at some of the companies like, Rushmore and SPS and others. I mean, you've got to remember these lenders are advancing Ginnie Mae advances, pass throughs month after month. And if they're not getting a principal and interest payment, for those that are not owned by a bank, like I was back in the day, where you had, lending credit alternative and stuff like that, people are out, basically on credit lines for stuff. And, it's put some companies out of business because you can only do that for so long, for sure.
Absolutely. And the other side of it is, what type of compliance and control measures do you have within these servicing shops and sub-servicing shops? Because compliance is not going to go away. Government oversight is not going to go away. And making sure that you're on the legal side, making sure that these people are compliant with regulatory issues. What are you seeing there?
I mean, I'm sitting here dealing, think just to give you a good example, we're getting that pretty much weekly from our client base. It's on the surveying side. The most recent one is UCC liens. So about a year ago, when I was on vacation at the beach, all of a sudden we started coming up with some situations where loan had been foreclosed, FHA, VA, trying to convey it to FHA or VA, and all of a sudden you got UCC liens sitting out there, which traditionally is not something you would actually look at in a title search on a foreclosure referral. And now we've got all these UCC liens popping up, and a lot of it's to do with like solar panels and other energy efficient, situations and stuff like that. But it was personal personal liens that somewhat attached to the property. And so now, we're all trying to figure out how to deal with it. VA just came forward and basically granted, extension approval anytime a UCC lien's identified post foreclosure, so the lender has an opportunity to deal with it to see if it's something that can be, released from the credit union or whoever it was that did the financing, or if it's something that needs to be paid off in order to get the full conveyance package. Because FHA and VA is not going to allow any exceptions in the title policy, and they want everything clean. So yeah, we're getting stuff consistently, survey information. We're in like 10 states, so we're able to kind of give it in a universal feedback manner based on power sale states like in Georgia, in Tennessee, and Texas versus judicial states, which a lot of stuff gets worked out in the court system. But yeah, it's definitely part of the role we play now is doing research and providing feedback to the clients on not only regulatory issues, but just other legal issues that are associated with, the conveyance of properties and, marketable title and stuff like that.
So taking that conversation a little bit further, maybe deeper, if you will, but if you were to say right now, being in this arena, what is a service or a subservice greatest risk right now moving forward?
Uh,
Not to
well,
put you
what
on the
may,
spot, but
yeah,
I
yeah, that's
am.
kind of tricky. Well, the first thing that jumped in my head, and I'll just say it, is all this consolidation we're seeing. I mean, with the Rocket and the Mr. Cooper and the Sinlor and
Right.
Penny Mac, and you just see all this consolidation like I saw back in the 90s when you had, the Wachovias and the Nations Bank and Bank of America and all the other entities start to consolidate, because you got to remember an MSR is a commodity, pretty much like everything else. And everybody, if you're not doing kind of the name of the game all the way through my career is if you're not doing a lot of originations, you need to be purchasing servicing. And so
Right.
so it's kind of like six of one, half dozen of the other. So you're not seeing a big origination market. So you're seeing a lot of these companies starting to consolidate and merge, to put more MSRs on their books.
Yeah, right, right. And then there's all sorts of issues in terms of the continuity of those types of mergers, making sure that you don't have any additional risk based on gaps in your processes and all those types of things. That has to be prevalent, and it is a concerning issue. I wanted to go back to the conference you were just at. What other general themes can you think of that was there a general theme, like a quote or a saying of the conference that they were talking about?
It was mainly the conference was mainly focused around AI usage in the mortgage industry, along with the housing market, economy, interest rates, purchase power by borrowers,
Right,
no low to moderate income housing market these days. How do you try to solve that problem? I don't know. And to be honest with you, I don't know how you solve that problem, man. I mean,
right,
for, a young couple coming out of college, like my wife and I did back many, many years ago, trying to buy a home, if you're not making six figures, it's tough. I mean, it's
right.
just not a whole lot of options out there.
No, absolutely. And it's across the board. And yeah, I think, you hear these stories in the news about younger people saying, hey, home ownership's not important to me. Is that a byproduct because I can't afford it? Or is that really truly a statement that I don't want that type of risk? I don't want that type of commitment. What is that being driven from, right?
Yeah, I think it's starting to change too. I think it's a lot of the factors we were just talking about. I think it's the ability to buy a home and put a down payment down. It's because you got to remember a large majority of things that are being sold in the market these days fall into the jumbo package. They're not into standard FHA or VA guidelines and limits and stuff like that. So you've got to have the purchase power. And it gets very difficult when, you've got somebody trying to buy, a house when you get in 10, 20 contracts on a property when a property goes up for sale because of the housing shortage.
Right.
And but it's not honestly, I think we saw a period of time back 4 or 5 years ago where there was, a big shift in, people not wanting to own a home and stuff like that. I've kind of seen that change. I mean, it seems to be an influx of, new couples coming out, with kids and wanting to be in, certain geographic areas and wanting to be in a home and everything else, just like you and I did back in the day.
Right.
So,
Right.
but again, somewhere along the way, there's got to be a solution for that around interest rates and property values and housing inventory and stuff like that. And that gets back to the word everybody used at in the conference last week, which was stuck. It's just like
Yeah.
everything's stuck.
Right.
And I remember the guy from Fannie Mae, the economist Fannie Mae, talking about how there's really kind of two separate books of business. You got one book of business for people pretty much my age who either, if they have a loan, they're sitting at 3% interest rate with a large amount of equity. Most most people, including myself, sitting in homes larger than I really need. And then
Right.
you've got, everything that was kind of originated over the last 5 years, where you've got, very little equity in the home, and that sort of stuff. So you've really got two
And adjustables
situations.
and
Yeah, you've
adjustables.
got
Yeah.
you've got a situation where you've got, older individuals in homes that are either paid for, or they're at low interest rate mortgages with a lot of equity and they don't want to leave them. And then you've got everybody else that's buying what they can, and a lot of it's in inflated values. And there's a little bit of a joke around the discussion that first bucket, there's really only one way those homes are going back on the market, and that's if somebody passes away,
Right.
because otherwise they're kind of set and they don't want to leave where they're at. And
Can't
if they
afford to.
did, if they did, they're going to go overpay and they're going to jump into a 6.5% mortgage. So why would I leave? That's kind of the discussion that was going on.
Right. Right. Well, since you brought it up, I've got to ask, and give me a minute on AI. What are your thoughts?
Scares me to death, man. It really does. I mean, it's funny you even brought up the subject, man. I mean, with everything that's going on in Iran, and you're sitting here watching these robots run marathons, and how quick is somebody going to use that for like a military situation? And here we are at the Terminator episode,
Right.
and it's just like, oh my gosh. But in form of the mortgage market, I tell you one thing that really stuck in my head. Last week at the conference, there was an individual speaking about how they have AI working on automated responses to customer inquiries. And the conversation came up about, well, how do you make sure from a QC standpoint and from a QA standpoint that what's being articulated back to the customer is correct? And the answer to that was, well, you put another layer of AI on it. So you've
Yeah.
got a front end AI being monitored by a back end AI, and the whole concept just scares me to death. One
No,
thing I've told people, and most of our clients are very adamant about the fact that, we can't use AI unless we disclose it, which, I've kind of taken the position that I learned many, many years ago in the market. I don't want to be the one to take a bloody nose. I'd rather somebody else take it. So I'm just going to, we're kind of in a situation of sitting back, and then you get into the legal world and how AI fits into the legal world, and what does that mean in forms of lawsuits and litigation and all that kind of stuff. So we've steered away from it, and what I can see is in some of the case management systems that are for years and years on the attorney side, I can see some AI being built into that just from a production standpoint, just from a automation and more integration and that standpoint, but not necessarily from a customer facing and stuff like that.
No, sure, sure. I I
How
really
about you?
appreciate well, I see some, I go back to compliance and saying, if there's way to control and mitigate risk, that's look from originations all the way through default is being able to mitigate risk as it comes from an operational process perspective. I'm all for it. It's just another form of technology, right? But yeah, in terms of decision making, that sort of thing, it scares the bejesus out of me.
Yeah, but if when I go back to what I told you earlier about three forms of communication back when I started, and
Yeah,
then
yeah,
and then and now we're having this discussion, it's
yeah,
just
yeah,
like, wow, yeah,
yeah.
that's crazy. Yeah.
Well, Kenny, I really appreciate it. Good friend, very smart. I was so happy to be able to tackle you and bring you in here. And I really appreciate your time.
Hey, Mike, listen, man, it's nice to be able to have a conversation like this with somebody, especially somebody that you've known for as long as I've known you. And I really appreciate the outreach.
My pleasure. Excellent stuff. Everybody, thanks to Kenny again for being with us, and we'll see you soon.
Take care, Mike.
Take care.
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, visit BlackFin Group online at www.blackfin-group.com.